Hello and welcome to this programme from Baillie Gifford. My name is Gavin Lumsden, I'm from Citywire and I'm going to be talking to Matt Brett, manager of Baillie Gifford Japan Trust. This is a good time to speak to Matt with Japan's stock market having recently hit a record high and the economy moving out of a long period of deflation. Good afternoon to you.
Hi Gavin.
Right, nice to see you. Thanks for making the time. As I said, I've got some questions for you, so I'll just kick off straight away with, as I alluded to, Japan's stock market and economy have been in the news a lot lately. The Nikkei 225 index surpassed its December 1989 peak in February, but the low point was way back in 2009. So I wonder what makes Japan still attractive after a long, if intermittent, recovery?
Yes, I think you're right. That 1989 peak has been a bit of a psychological hurdle on the minds of the Japanese for the past now 35 years. And I think it's probably a good thing to see that in the rear view mirror now. And you're also right that the Japanese market bottomed quite a number of years ago now and has been making good progress since that time. And I think what makes Japan exciting for us is the number of interesting growth companies within the market, particularly in the medium and the smaller area of the market. And these have often been overlooked, in our view, by global investors over the recent years, given that Japan perhaps hasn't been centre of people's attention. But there's been a lot of exciting companies doing solid progress over the years. And I think that's what really makes us still excited about the prospects looking forward, even despite the fact that, we're 15 years from that bottom in the Japanese market.
Exactly. And on the economic front, could you tell us what's the significance of Japan exiting from deflation? The Bank of Japan has just about ended negative interest rates and yield curve control policies. What does all that mean for investors?
Yes, so I think this is a very interesting change. Japan's really gone through a period, post that bubble era, it had a period of deflation, and that was very difficult for Japan. And then more recently, it had this period of kind of no-flation with neither really inflation nor deflation. And more recently, we seem to actually have inflation in Japan again. We're seeing property prices increasing, we're seeing wages going up, we're seeing prices of consumer goods rising in Japan. So it's quite a broad-based inflation, not anything to be concerned about, but certainly a healthy level of inflation. And I think the Bank of Japan moving away from the negative interest rate policy and taking those baby steps towards normalizing the interest rates is just really a reflection of where the Japanese economy is getting to, which is it's no longer really in those special measures of the past. It's behaving a lot more normally. And I think for investors, I think what is exciting is that, deflation is a difficult environment for investment. It really weighs on things. It makes it very difficult to achieve returns. And I think that ending of that, is helpful for a number of companies. And combined with your earlier comment about, the Japanese market getting past that 1989 peak, I think there's a real potential here for what the Japanese would describe as the animal spirits, to continue from here. That those things now, those problems of the post-bubble era, they really do feel like distant memory in Japan now. And I think hopefully what we can focus on are the individual companies and what they're able to achieve in the future.
Okay. Well, talking of companies, it's good to see the Japanese stock market doing better. But why are large companies seeming to benefit the most from the recent rally?
Yes, that's right. So recently, a lot of the good performing stocks have been the large export companies, driven by the weak yen environment, and also some of the large banks as people have started to worry less about inflation. And so, shareholders in the trust have had quite a disappointing period of relative returns, albeit, generally prices have been increasing because basically we haven't been able to keep up with those exporters, driven by the strong cyclical background globally and the weak yen environment.
Okay, and then given that, what can you explain why you've skewed the portfolio a bit more towards smaller and medium-sized stocks?
Well, essentially, this is a long-term strategy that we've employed for many years, and it doesn't work clearly every year or every few years. But What the reason fundamentally for being more interested in the medium and the smaller companies is we think ultimately that's where you have the greater growth potential, particularly when we think about the domestic economy of Japan, albeit it's recovered again. But the population of Japan is pretty static. It's a very wealthy country. So in order to find a growth company, you really need a company that's a medium company that can take share within the market over time. And that pulls us towards some of the domestic internet companies and things like that. And those companies naturally are the ones that are medium and smaller companies. And on the other hand, when we look at the index as a whole, some of the big areas we're just not super excited about. When we look at those mega banks in Japan, they're perfectly solid, but we don't see particular growth prospects there. And when we look at, for example, the big car companies in Japan, we really struggle to see how there's going to be much growth in the type of vehicles that they are selling, given the increased competition coming in the battery electric vehicle market, both from Tesla and also from the Chinese competition. So some of those big areas within the large cap area, we just structurally don't find particularly attractive. Now, that's not to say that they can't go up quite a lot for a year or two, but in the long run, we're much more excited about those small and medium-sized companies as a whole.
Okay. It's been a difficult couple of years for your sort of quality growth approach. Just wondering, how cheap are these stocks at the moment?
Yeah, well, I mean, there's lots of different metrics that one can look at, but I think what is striking is it doesn't seem to us that you pay much premium at all for growth at the moment in Japan. So, for example, just looking at the Bloomberg analysis of the Japan Trust portfolio, it suggests that the portfolio is only on a price to sales of 1.1 times, which seems remarkably low to me for a growth portfolio. And I think, when we look at the earnings of some of those companies, particularly the car companies, they've done very well recently, buoyed by the weak yen. But if we start to think about adjusting those for the cycle, some of those companies actually look quite expensive now to us relative to the more genuine growth types of businesses.
So that's a good position from which to go from, hopefully. Your long-term themes remain digitalization, automation, and artificial intelligence. Can you update us on each of these and give us some examples of key stocks, please?
Yeah, so I think this is this increased use of technology is something that we're seeing across the whole world. But I think it's been accelerated at the moment by the developments in these large language AI models. And also in many cases, Japan is coming, particularly in the internet space, from a place that's not quite so advanced as in the West. And so we've got companies at an earlier stage of development. So for example, looking at that internet area, a couple of the companies we're really excited about at the moment include GA Technologies, which does online real estate sales, and also Bengoshi.com, which is a forum for lawyers. And they've also developed a kind of document signing business, a bit like DocuSign. So these companies are, still relatively small within the context of real estate or within the context of the legal system in Japan. But we believe they've got good competitive positions and a lot of growth ahead of them. And then in automation, I think we all know Japan has a very good reputation within robotics. We've got the classic strong Japanese robotics company Fanuc within the portfolio, but also, for example, we've got within machining centers DMG Mori, which merged a few years ago now, with its German competitor Gildermeister to create an overwhelming number one globally in that area, and that's managed to get the margins up, and that's been doing well. And broadly speaking, we're super excited about the prospects for automation, because what we're seeing is the potential for AI and machine vision to make robots a lot smarter than they have been in the past. And a big opportunity for Fanuc is cobots, which are robots that work alongside humans and are capable of stopping moving if they come across a human, etc. And machine vision and knowledge of the environment makes those robots an awful lot better, and we think there could be good growth potential there. And in terms of AI, I think this is one of these kind of mega themes, a bit like the internet, which is going to cover a whole host of different companies. But for example, within this portfolio, long-standing holdings like Rakuten and CyberAgent, both of these companies have huge numbers of customers, and that gives them access to lots of data, which is really what you need to feed these AI models with to create differentiated services and product offerings. And talking to the president of LY Corporation, formerly known as Yahoo Japan, they're talking about getting efficiency gains of about 50% on software engineers, software developers, basically. And these gains are absolutely massive. And in a country that maybe doesn't have quite as many software experts as some countries, I think this is going to be a huge benefit for Japan as a whole.
Okay, very interesting. Thank you. Let's turn to SoftBank, which is your biggest holding and has been a bright spot lately. It surprised the market with better than expected annual results in February. Perhaps that wasn't a surprise to you, but yeah, I just wonder, what are the prospects for Arm Holding, its biggest investment, as well as the rest of the portfolio?
Yes, SoftBank's one of these companies where I think lots of people, if you read the papers, you'd imagine SoftBank has been a pretty disastrous company, but quietly behind the scenes, Mr. Son has been having some good successes. And the most recent one is Arm, where he bought this from the UK market in the wake of Brexit. And at the time, people said maybe he's paid too much for it, etc. Anyway, he's recently relisted it on the Nasdaq, making 3 or so times his money on that company, which is quite good for a few years' work. And I think the real excitement with Arm is it's got a kind of monopoly on the architecture of mobile phone chips. And those chips are going into more and more types of devices and are very important, in terms of AI, having more powerful architecture within mobile phones. So it seems to be one of these rare businesses that has a very dominant position in what it does and good growth prospects ahead of it. And I think that's been better recognized now. But looking beyond that, SoftBank has some other quite exciting investments. For example, it has a stake in ByteDance, which is the owner of TikTok, a company which continues to grow very fast and have a lot of excitement. And they also seem to be working very hard at the moment on developing autonomous driving systems, combining that chip type of knowledge and also the AI type of knowledge. And it looks like they're trying to get cars to be able to drive themselves in a more almost human-like fashion than the current autonomous driving efforts. And if they can pull that off, that would be very exciting. So I think, my broad joke with SoftBank, is, if we could all fail as well as Mr. Son, we'd be doing quite well, because there is always this gap between the news and the reality. The reality is Mr. Son again has got the company into some very exciting places, and actually those profits are starting to come through again.
Okay, good to hear there's a turnaround going on there. The trust benefited from a private equity bid at a big premium for outsourcing the staff company recently. Has M&A, mergers and acquisitions, been a theme evident elsewhere?
Yeah, so there's various bits of M&A happening in Japan, and I think the old perception is that Japan's a very difficult market to do M&A in, but I think that's really changed over the years. And we see, for example, this private equity bid for outsourcing, but we've also seen private equity bids for some of the holdings within Shin Nippon, the smaller company investment trust. And we've also seen kind of more restructuring type of M&A. So, for example, the holding in Rome, is part of a consortium, basically restructuring Toshiba, which is very exciting as well. So I think, that aspect of Japan and restructuring things, I think has been quite helpful. And I think almost the odd thing is that as Japanese companies are getting a bit more confident again, they're almost a bit more prepared to take some of these more tricky decisions, to restructure or do M&A to try and, improve the competitive position. And perhaps they were, during the darker days of the last 30 years, when maybe they were more focused on, staying alive rather than looking forward. But that's very much in the past now.
Absolutely. Okay, I'm interested to know which stocks you picked when you were reinvesting those gains from outsourcing. Because you also made some money on Itoshu, a trading company that you sold after a share price re-rating. Yeah, what did you do with the cash from those two sales?
Yeah, so in general, look, we have a very, very low turnover style. Annual turnover, is typically in the low teens. So, very much what we're doing is buying the companies that we think have the good growth prospects and then holding them for the long term. In the case of Itochu, one of the big general trading companies, we've held it for many years. But the reality is the shares have done incredibly well. And, Mr. Buffett has nicely advertised the benefits of the trading companies, but they're over double the price generally of where he was buying as well. So, we think they've pretty much done as much as they can. And in terms of reinvesting, it's gone into a variety of different things, but some examples would be Sato, which does barcodes, which fit really, really nicely. Barcodes and RFID chips fit really nicely with the whole AI theme in terms of labeling up things so that computers can understand which packages are going where. Lots of potential in the food industry, also the medical industry. Also more into GA Technologies, the real estate, online real estate company I mentioned earlier. And finally, some into Oisix, which does meal kit delivery services and has recently acquired a competitor to give it much greater scale. So I think, each of those companies are probably not exactly household names, but these are medium-sized companies that we think have very strong growth prospects ahead of them.
How is China's weak economic recovery affecting Japan? The delayed return of Chinese tourists affected stocks such as Shiseido and Polar Orbis, half-year results recently showed.
Yeah, that's right. So, during COVID, we invested in a few different things that had been having a difficult time through lack of demand. Some of those have worked already. So, for example, Bridgestone in tyres, that's worked pretty straightforwardly. People started driving again and flying again. It does plain tyres as well. And the profits have recovered. But those skincare companies have been slow to recover. And a good part of that is the Chinese consumer hasn't really got going yet as fast as, for example, the Americans have. And I think, looking forward, I don't think we have great concerns here. We think it's just a matter of timing. The competitive positions of those cosmetics companies remains very strong in China. But what we're really waiting for is for the Chinese consumer to get fully back onto the front foot. And I think basically what we've seen is that there's been a bit of a lag in Asia compared with the West in terms of getting through COVID and mentally as well, just getting really back onto the front foot. And I think, Japan seems to be about 6 months behind the UK in terms of reopening and things like that. And China seems to be 6 months behind Japan. And, one of my colleagues is literally just back from visiting China, gone to check out some of the competitors to our companies, etc. And the report is that, things seem to now be picking up in China, which is, I think, quite encouraging. But in the long run, when we look at the spend that the Chinese have on skincare, it's still a fraction of the amount that the Japanese are spending in this area, or even the South Koreans are spending. So what we think is that these skincare companies, have this huge long-term growth opportunity ahead of them. We're happy to be patient and just wait for that recovery to keep coming through.
Okay. Let's turn to gearing, or the trust's ability to borrow. Gearing stood at 19% in February. How does that compare with the past? And what does it say about your confidence in the trust's investments?
Yeah, I mean, the gearing over the years has ranged from kind of about where it is now, high teens, down to kind of about 10% or so. So we're at the more optimistic end at the moment. And gearing is really a call on the absolute potential performance of the stocks that we invest in. And in that sense, we still feel really optimistic because, going back to your opening comments, although the Japanese stock market as a whole has done really well, many of our companies haven't done especially well yet, and we still see a lot of opportunity for them. And that's why we've got the gearing, towards the upper end of the range at the moment. And, we wouldn't take it actively, over 20%. So we're pretty much, at the maximum level of gearing at the moment. And that just reflects the enthusiasm we have for the portfolio.
Okay. And meanwhile, the Trust shares trade at a relatively wide discount of 12%. The board's been buying back shares, which is good, about 3.5% in the last half year. Again, what message do those stock repurchases convey to investors?
Well, look, stock repurchases at a discount, increase the NAV per share for all remaining shareholders. So hopefully they're seen as a good thing by all the shareholders. And 3.5% of the company bought back in 6 months. It's equivalent to 7% in the full year if we keep going at the current rate. So I think, these are more than tokenistic types of buybacks. It's really, actively making a decision that discount does look wide. And the board is prepared to buy back. And also the Japan Trust doesn't invest in any unlisted companies. There's not so many bigger unlisted companies in the Japanese market. So, it's very easy for us to buy back and maintain the shape of the portfolio exactly how we'd want it to be. So yes, I think there's no change to the board's fundamental thinking.
It's interesting when you put that 3.5% on an annual basis. Obviously, at 7%, that's getting towards the level of obviously your a Scottish Mortgage, Baillie Gifford's big global trust, announced a big share buyback of a similar sort of magnitude, actually.
Yes, I think they are similar. If anything, it might even be the case that the Japan Trust over the past 6 months is going at a slightly faster run rate. But obviously, the Japan Trust is a very much smaller trust than Scottish Mortgage, so the absolute amounts are much smaller. But yes, in terms of buybacks, it's a serious amount of buyback.
Okay, thanks, Matt. Well, as a proportion, it's showing some conviction in the buybacks. Let's turn. That's all the questions for me for now. But let's turn to our audience's questions, and I'll start with one that we got just before the programme started. So I'm going to. It's a good question, but I'm going to ask it so I don't forget it. But it's about the dividend policy, which we haven't touched on, and linking it to corporate governance changes in Japan. But the question is, Japan's trust performance mirrors that of most Baillie Gifford trusts. What I'd like to know, says the investor, is how the regulatory changes in Japan encourage, among other things, increased payouts to shareholders. Baillie Gifford has, over the years, made a big thing of its trust not paying a decent level of dividends, being growth funds. However, it's periods such as the last couple of years where being paid while one waits for capital returns is helpful. So, there's an investor appreciating the dividends. But, what is the trust dividend policy at the moment?
Yeah, so essentially there's two parts to this. There's the dividends coming into the trust from the underlying holdings, and then there's how the company itself treats the dividends. So in terms of the dividends coming in, we have seen quite a rapid increase in companies paying out more than they used to. And this is part of a long-standing journey. I'm not totally ancient, but when I started doing Japan, you'd meet companies and they'd say our dividend policy is 50 yen. And you say, why 50 yen? And it was just 50 yen. It had no relation whatsoever to the earnings or the balance sheet or anything. It was just 50 yen. And now, we went through a period of focusing on payout ratios. And now, with the governance code and the stewardship code, companies are increasingly, thinking about the balance sheet as a whole and how much is appropriate to pay out. And that journey has continued. And obviously, although it's not the main focus of this trust, the side effect is, more dividends being paid out even by the growth companies. And most internet companies in Japan, most companies indeed, pay dividends, which is quite different to many growth companies globally. And the trust has got that income coming in. So, over the past few years, there's been quite a dramatic increase in the dividend being paid out by the trust because to start with, it had accumulated revenue deficit, and that was paid off first. And so the trust first paid a dividend of under 1 pence a share back in 2018. And then the dividend since then has gone 3.5 pence, 4.5 pence, 6 pence, 9 pence, and last year 10 pence. So the yield on the trust at the moment is about 1.3%, which, the focus remains very much on the capital growth. We're not trying to run a particularly progressive type of dividend policy, but it just happens that those dividends have been increasing strongly from the underlying holdings. And then the trust, the board has been, paying out the minimum dividend rounded so far, and that's been the outcome. Now, the one thing I should also note is that, of course, all the income is in yen. So, the dividend as paid out in sterling, you could see variability on that because of the effects of the currency. But I think, it just really reflects the dividends that are coming in. And when dividends come into an investment trust, the vast majority of them are automatically paid out to maintain the investment trust status. And that's what we've seen in the past few years. And looking forward, I don't see any sign that the company's enthusiasm for paying out dividends is diminishing. And the other thing is you're also getting quite significant buybacks from many Japanese companies, and you don't have much options issuance in Japan. So often we've got dividends coming in and growing on a shrinking share count for many of the businesses, which in the end, should be quite helpful to the shareholders of the Japan Trust.
Okay, and actually, the question about you mentioned the currency, which can be quite volatile and affect investor returns, as you just said. How do you manage the currency side of things? Do you hedge it at all?
So basically, we run the trust entirely effectively in yen. So we don't do any hedging. It's an unhedged vehicle, and the board has considered in the distant past hedging, but decided not to consider doing it. And the loans that the trust has for the gearing are all in yen, so they don't create any currency exposure either. So, where there are borrowings, they're being borrowed in yen, all the investments are in yen. But obviously there's a translation effect back into sterling in terms of the reported results, and there's a translation effect in terms of dividends. The amount being paid in sterling is obviously dependent on both the amount coming in yen and then also the exchange rate.
Okay, thank you. I've got a question about the revenue returns, which I think might link with dividends, but maybe with the currency as well. But a question from an investor who notes that the revenue return per share rose strongly from 2017 to last year, but then fell back. They wondered what has been driving that.
I think there's two effects here. There's a bit of a currency effect going on with the weakening yen and then being translated back into sterling, which is what you will see within the accounts. And also, as it's been a very difficult environment for growth companies in Japan, we've been slightly leaning the portfolio towards some of those smaller, higher growth companies, and they're often coming with a slightly lower dividend yield. So what we're aiming for here, is for total returns. And if we see more opportunity within something that yields a bit less, then we'll happily sell the higher yielding company in order to buy the lower yielding one. But nonetheless, the overall trend, I think, is still, positive in terms of what Japanese companies as a whole are doing with dividends.
Okay. There's a viewer who's wants to ask you about the state of the Japanese stock market and how it seems to be quite polarized. So the question is, two questions. How do you look at growth versus value in Japan? And an observation that activism seems likely to last many years and it seems to be doing well. View on growth versus value currently, and also whether you get involved with any kind of activism or engagement.
Yeah, so in terms of that growth versus value thing, it's definitely been the case that, the past kind of 2-3 years, it's very much been a time for the value type of investor in Japan. And we've suffered relatively as a consequence of that. We talked about some of the reasons earlier. That strong global cyclical recovery combined with a weak yen is a perfect environment for, businesses that maybe don't normally have terribly high margins. but it really helps them along a bit. And then in terms of the opportunities, I think what we've seen is, in share price terms, many of our favourite companies have kind of gone sideways or down for 2 or 3 years. But under the bonnet, they've still often been growing their sales, growing the earnings. So they've basically just been becoming cheaper. And when we look forward, we can't really get so excited about some of those, let's say, cheap but not really fast growing companies. And yes, when some of these companies, traded at a big discount to the book value or something like that, undoubtedly there was some kind of value in them, and that value maybe has now been realized. But looking forward, they're still the same companies as they were before. They're not likely to have a high growth rate ahead of them, and therefore we don't find them so exciting. And I think on this activism thing, it's an interesting question, and it appears to be a separate question, but in some ways it might actually be the same thing, because I think many of the activists have been targeting these more value type of companies. And as a result, it appears there's been very good returns from activism in Japan. But of course, it may be there's been very good returns from value stocks in Japan, and activists have tended to be in those value stocks. So, of course, there are cases where the activism will have encouraged things or moved them along a bit faster. But I think there's also an element here to which the returns achieved by activism may have been somewhat flattered in the past 2 or 3 years by the fundamental nature of the companies that they're investing in. Now, when it comes to us, I mean, generally speaking, we invest in companies with management that we like. And generally we're backing the management. There are occasions, when we have made observations, with regard to the balance sheet conservatism, maybe, we should think a bit about that, etc. But in general, we're more at the supportive end of shareholders, and we're trying really to encourage companies to be bold enough to seize the growth opportunities ahead of them, rather than to be focused so much on the dividends and the buybacks and so on. But there are occasions, when we do engage with companies. But I think the main point here is that when we're looking at the companies that we invest in, many of them have a founder shareholder, which gives us natural alignment. And they want to make money themselves. We want them to make money. We want to make money together. And I think in the long run, that's probably a more reliable method of making money, rather than kind of agitating, for shorter term change.
Understood. I question here about what lessons may have been learnt from during the performance difficulties of the past few years. Has style and diversification of portfolio been reviewed during this period, or as a result of this period?
Yeah, I mean, we've certainly looked at how we could have done better. And with some of the aspects, like, for example, thinking about, cars and banks doing very, very well, we don't worry too much about that, because, I think it's not naturally what our main focus is. But one area that we have picked up on, is we did sell out of some companies like Advantest and Disco. Advantest does memory testers, and Disco slices up wafers. Now, these companies have come very much into the focus in the last year or so with that AI boom. And looking back, we were perhaps too hasty to exit those companies. Now, the reason we did is because we saw even more opportunity in some of the internet, more software type of businesses from AI. But certainly, had we not done that, the returns, would have been better. And I think that's something that is a learning point. Whether we're going to improve things by getting back into those stocks at this stage, I think that's a very open question. I'm not convinced about it, but certainly that's something that we would acknowledge as being something that we could have done better in the past few years. But a lot of these things, you have these quite big swings in performance. And ironically, we were getting a bit of challenge, a couple of years ago about, are we growthy enough? And I think with the benefit of hindsight, I think we can see we were more than growthy enough, and if anything, perhaps a bit too growthy. But at the same time, growth seems very much on sale at the moment, and that's why, at the margin, we're pushing the trust, further down the market cap spectrum a little bit, and pushing it into these higher growth names, more than before, and selling some of these names that maybe we feel, things like Itochu, nothing wrong with Itochu, but we feel it's largely done its stuff and there isn't as much opportunity there. So effectively, we're running at the moment with a slightly purer version of our natural style than perhaps we had, 5 years ago. And that's been undoubtedly a rough ride in the past couple of years. But in the long run, if these companies can continue to show progress, and we've seen progress with SoftBank with its ARM listing, and we've seen progress with Rakuten, the second biggest holding, getting more subscribers into its mobile business. So we're seeing operational progress for the individual companies. And I think, that gives us a lot of comfort that, over a longer time period, these companies' share prices will gain more traction.
Okay, that's great. Actually, a linked question here. Viewer would like you to would you break out the difference between the large and mid caps in the portfolio? What's the allocation? And then a follow-on question, because it does seem to be more skewed toward mid caps at the moment. Is there an overlap with the Shin Nippon Smaller Companies Trust?
Yeah, so, it's not that we don't invest in any large caps, certainly, but, we just have a lower weighting there. As we spoke about earlier, being a growth investor, I think that's quite natural when you look at, what the big companies in Japan are. But for example, as of the half year, the TOPIX 100, the equivalent of the FTSE 100, that was 66% of the market cap of Japan as a whole, whereas it was 42% of your company, of the Japan Trust. So in that sense, we're structurally, quite a bit underweight those very biggest companies. And sorry, there was a second part. The overlap with Shin Nippon. So there is some overlap with Shin Nippon, and it's been pushing up a little bit, but it is a pretty modest overlap between the two. So we're talking, low teens type of percent at the most overlap. And the reason for that is because Shin Nippon really specializes in these, really quite small companies, whereas the Japan Trust is more a kind of, it's got a mid and small cap bias, but it's certainly by no means a pure small cap trust. And companies, for example, like SoftBank, are among the bigger companies in Japan. So I think Japan Trust has a broad remit. There's nothing to stop us investing in larger cap companies. What stops us doing it isn't their size, it's their growth prospects, which often seem to us quite dull.
While we're making those kind of comparisons, another question asking how similar is the Baillie Gifford, the Japan Trust, to the open-ended Baillie Gifford Japan Fund that you also run?
Yeah, so basically the overlap between the Japanese fund and the Japan Trust is more of the order of 2/3 overlap. So there is much more similarity between the Japanese fund, the open-ended vehicle, and the Japan Trust than there is between Japan Trust and Shin Nippon. The difference is mainly in those small and mid-cap stocks where, Praveen, who manages Shin Nippon, is the deputy manager of the Japan Trust. And, it can and does go further down the market cap spectrum than the Japanese fund does. And that gives us access to, a few more of those smaller types of companies. The Japanese fund tends to go down to a market cap, very roughly of about 100 billion yen. So we're talking here, depending on where the currency is, I would have said in the past, something near to $1 billion. But now, it's a bit smaller than that, whereas the Japan Trust can go down significantly smaller than that.
Okay, two more questions I think we've got time for. And the first of those is going to be, we were talking about gearing earlier on. You're explaining your approach to using borrowing. But the question is, given the market over the past few years, wouldn't it have been sensible to reduce gearing?
Yeah, I can totally get where that question is coming from. Here we are cheerily talking about the market being at an all-time high, and here we are with maximum gearing, and it's a very logical question. I think, though, when we look at the portfolio that we have substantially lagged that overall market. So most of our stocks are not at all-time highs, and therefore, we feel quite confident, in thinking that it's the right thing to use the gearing. And going back to that dividend point, I mean, the cost of borrowing in Japan remains incredibly low. So we're getting in kind of more income in many cases from the companies we're buying than we're paying out on the loans. And I think, that gives us, quite a degree of conviction here.
Okay, brilliant. And so the last question is, I mean, again, given the difficult few years, looking ahead though, you've expressed your conviction in the growth stocks you've got, but it's an inevitable question really from an investor. What is going to improve the performance over the benchmark in the next few years?
Well, I think at the end of the day, what I would expect to improve performance versus the benchmark is how those individual companies do. So, when I look into the benchmark, I see those big car companies often with earnings that are hitting all-time highs in the case of Toyota Motor. But as I look forward, 5 to 10 years, I see loads of competition coming, from those Chinese battery electric vehicle makers, from Tesla. I see potentially it being a very difficult environment for Toyota going forward. Whereas many of the companies that we invest in, those internet type of businesses, those factory automation type of businesses, etc., I see as continuing to be able to grow their sales and profits over time. And it's an old adage about in the short term, the market's a voting machine, and in the long term, it's a weighing machine. But I think, the type of situation that will help us is if those sales and earnings keep coming through for our companies, and you start to see some of those, more value type of companies, struggling to grow their sales and their profits, I think that's when you'll start to see the differential in share price performance. But look, telling exactly when things go well or badly is a really difficult thing. Who would have known during COVID, for example, that Baillie Gifford portfolios would turn out to be quite a good place to have your money. If you'd asked me in advance, there's a global pandemic coming, will it be good or bad? I think it would have been a brave thing to say that it would be a good thing for the portfolio, but actually it turned out that it was. And similarly, we are in a situation now where, we have already seen quite a big global recovery coming out of COVID. We've seen this burst of inflation, which has been, difficult and confusing for people, and is probably weighed on the prospects of growth companies. But we've also seen, digitalization and AI continue to develop. And I think, in terms of the companies we have, we think many of them remain, very strongly positioned for the future. And therefore, my conviction comes from being able to take a longer view on things, and expecting that in time, those companies that grow their sales and their profits will become better rewarded by the market. But in the meantime, we have to be patient and, I guess, keep going with the buybacks, etc., for the time being.
Okay, Matt. Well, thanks very much for your time. Let's hope the re-rating follows the progress and innovation that you've been talking about. I hope that what you've heard has provided some helpful insight into the Japan Trust and where it invests. But in the meantime, from me, thank you very much and goodbye.